in trading is like the goal of any business, is to generate profit by taking calculated risk. We've already discussed basic probability and how practical probability plays out with the law of large numbers to approach the theoretical expectation. Be sure to watch that video if you haven't done so already. In order to establish realistic probabilities in our backtesting, it is critical that we choose a profit ratio, backtest with that profit ratio, then stick to that ratio while we trade live markets. Let's begin with the definition. What do I mean when I say profit ratio? It is essentially the profit we are seeking divided by the stop loss we use to manage risk. So let's look at the Pro Analyzer. You can see here that we have some values that are provided. We have the average win here, which is $4.18 for this particular chart. We have the median winning trade, winning signal. That gives you $2.16. And then down here we have our suggested stop loss of $2.47 under the current price. All right, so to get our ratio, let's bring up a text editor here. And basically what you're doing is you are going to take your profit. In this first case, you're going to take $4.18 and you are going to divide it by $2.47. And when you do that and reduce it to lowest terms, you're basically going to get 1.69 to 1. This is one way that we could write it. Another way that you could look at this is you could say for every dollar we risk, we're expecting $1.69 as our reward. So this total is called the ratio. And then this top number here of that ratio, I like to refer to as our profit factor. All right, so that's one strategy that we could use based off of this data. Another strategy that we could do is we could go for the smaller number. We could say we're seeking that $2.16 profit, and we're still going to risk that $2.47. And again, when you reduce that to lowest terms, you're going to get 0.87 as your profit factor, and we could put that over 1. And again, that means we are risking $1, and we're expecting only 87 cents in return. And you might say, well, hey, that that don't sound like a good trade-off. But we'll talk about that. There are times where your reward being smaller than your risk, it can play off. As with anything in life, there are some nuances. There's yet another way that we can use this. One thing that we could do, I've got this line set here on the $15 level, and we could create a strategy where, we're not interested in making $2.16 in profit per share. We're not interested in $4.18. We want to try to get a big bite. And we look back through here and we do see enough of these trades make sense to try to hit that $15 level. All right, so, risking $2.47 to hit that $15 profit, heck, it hits. It hits sometimes. You go through long spells where it doesn't. But just for sake of discussion, let's figure out what that ratio would be. Okay, so again, we're going to go over here, and we are going to take our $15 profit divided by our expected $2.47 stop loss. And when we do that, we find that we are expecting to gain $6.07 for every $1 that we risk. So, hey, that seems like an attractive proposition. And so you can see here what we're doing is we are using data, whether it's the graphical data that's put out by the Pro Analyzer or it's the actual numerical data here. We're using data to drive our trading decisions. And when you hang out around a lot of people that call themselves traders, you're going to see a lot of rocket emojis, people talking about having diamond hands, talking about prices going to the moon. There's a lot of people that call themselves traders that they buy an asset and they hold on for dear life and they hope the price will go up and make them rich. They'll buy 1 million shares of a penny stock, and if only this stock goes to $1, they'll be a millionaire and they'll be able to tell their boss to screw off and so on. All right, that's not what we're about here. What we're about here is driving our trading decisions by data. And then not just blindly trading this data, but we're going to use what we learned in the probability video, and we're going to combine the probability and the ratios, and we're going to back test that. And we're going to see, is there a chance of profit? You're not flying blind here. A lot of indicators, they'll tell you you have, a 90% win rate, but they don't give these specifics. So we give these specifics. The software calculates it automatically, and sometimes the numbers look good, other times they don't. But we show them either way. All right, so you're not flying blind, you're not living off of hopes and dreams. What we're doing is we're setting up ourselves for the possibility of success. All right, so now that we've defined profit ratio and we've given some examples of profit ratios, let's talk about how this works with backtesting and how that affects our, our probabilities. And so in that first example, let's say we got a 40% win rate. So our 1.6 to 1. Let's say 40% of the time that wins, which means, of course, 60% of the time it loses. So we come over here and write wins. All right. And, you're winning less frequently than you lose here. For our other strategy, where we were gaining 87 cents for every dollar that we risk, let's just say that 60% of the time in our back testing, that won, which means 40% of the time it would lose. And last but not least, where we were seeking those big trades, we were getting $6.07 reward for every $1 that we risked, but going back through there, it's obvious that doesn't happen as often. And so 80% of the time you're going to lose, and let's say 20% of the time you're going to win. Now, keep in mind, these are hypothetical numbers. I pulled these out of my rear. I'm not going to spoon feed you and figure these out. You need to figure out your exact ratios. But I did pick these numbers on purpose because typically the more reward that you expect, the more risk is going to accompany that reward. And so oftentimes your win rate is inversely proportional to the amount of money that you win. And so the more money that you win, the less frequently you're going to actually have winning trades, the lower your win rate will be. And the less that you gain, like in this example, the more frequently you're going to win. So you're going to get a smaller profit, but you're going to win more frequently. And that's what I mean by an inverse relationship. In a lot of ways, it's kind of like like with baseball. Home run hitters, the sluggers, oftentimes have terrible batting averages. Whereas your base hitters typically have a higher batting average. But at the end of the day, both types of players score runs and they stay in the major leagues. It's the same way with trading. This is not necessarily right, and that's not necessarily wrong. It just depends on the trader. Most people don't have the mental fortitude to lose 80% of the time to get this bigger win. More people are better suited to winning 60% of the time small, even though that may not be as profitable. We'll have to work that out here in just a little bit. All right, but that's something to keep in mind. We're all a little different. We all handle loss and success differently than each other, so you need to kind of figure out what's going to work for you. So what do these ratios and what do these probabilities mean in terms of theoretical profitability? Well, there's a really simple formula for that, and it's basically this. Your profit is going to be equal to the number of wins times your profit factor, and then you're going to subtract from that the number of losses. Okay, so for example, in the first one, where we have 40 wins because we're winning 40% of the time, and then you're going to multiply that by 1.6, and then you're going to subtract the number of losses, which is 60. And when you do that, you can find that you would have a theoretical, basically $7.60 profit per dollar that you're trading over the period of time. And then you can divide that by the asset price and multiply by 100, and that gives you your expected percentage over time. All right, so this is profitable. If this number is negative, that means you for sure have a losing strategy. Again, profitability here is not a guarantee. We'll talk about that more in just a little bit. We can do the same thing for the 60% win rate. You can say you win 60 times, you're winning 87 cents, and then you'll subtract from that the 40 losses. And when you do that, you'll find that your theoretical profit is $12.20. So you can see that even though we're only gaining 87 cents because we gained it so much more frequently, this is actually possibly going to be a more profitable strategy than the first. And the last one, where you are only winning 20 trades, but you're winning $6.07 per trade. You subtract from that the 80 losses, and you'll find your theoretical profit is $41.40. So if you have the discipline and the mental fortitude to deal with losing 80 trades, this is pretty awesome to look at. Now, I can see some of you already in my mind's eye getting more excited than you should over these numbers. I mean, especially this one here. But let's talk reality. So number one, like I mentioned before, these win rates, those are purely hypothetical. Now, these ratios are real, and we talked about where those came from, but these ratios, completely hypothetical. I did choose them because this is kind of a general representation of what you might be able to expect, but you need to do the legwork and actually figure out those ratios yourself. I'm not going to do that for you. I'm here to teach you how to trade. I'm not here to do the trading for you. And these win rates and ratios are going to differ from asset to asset. It could be several years from now when you watch this video and these values will no longer apply. This is something that you've constantly got to work at. Okay, so this is hypothetical. The second thing to keep in mind that all this stuff comes with the benefit of hindsight. Okay, so we're modeling this off of existing market data. Do any of us know where Tesla's going to be as we continue? No, we don't. You could say some gurus will tell you they know, they don't know. Anything can happen at any time. It could go up, it could go down, it could go sideways. We don't know that for sure. Okay, so another thing that can happen is gaps. So sometimes gaps in market pricing can cause you to take a bigger stop loss than you were anticipating. On the plus side, you can also get some bigger profits. So I see a gap right here. All right, so let's say right here you entered on this long signal and you were still in this trade, but then here's this gap. You see where the price closed here one day and then opened way below the next. And if you actually measure that move, you'll find that you lost $3.47, which is like $1 more than you expected to lose per share. So it is possible, even though that you set the stop loss here, it may not fill at that price. And so you need to keep that in mind. And sometimes you can gap way down and take a much bigger stop loss than you were anticipating. Now, there is a plus side of that. You can see here that the market gapped up. So let's say you were in this long position still, and you had set maybe a profit target that didn't quite hit, but it also wasn't quite this high. And, you gapped up $11.38. I mean, that's a great day. There's no better way to start the day than gapping up $11.38 and taking that massive profit. But keep in mind, that can work against you too. And so when you are back testing, watch out for things like that. Make note of it. Oftentimes, over the long haul, They balance each other out. But you got to be prepared for this. This is where it hurts. This is where you're happy and you think you're on top of the world. This is where you're down in the dumps, hating yourself for trading. Okay, so you need to understand that that happens. And so there are nuances. It's like anything in life. Nothing's ever, exactly like the theoretical. All right, so don't get too excited with those numbers. What you are looking for is make sure that those are positive numbers. What you're doing is you're setting yourself up based off of data, based off of back testing. You're trying to find what could be profitable. It doesn't mean it will be profitable, but you're managing risk. You're trying to cut your losses and you're trying to maximize your gains. And so, the first thing is a lot of people don't like the idea of losing trades. And a lot of new traders will do anything oftentimes to try not to lose a trade. And that's the wrong way to look at things. And so you could look at losing trades kind of as a business. Let's look at trading as a business, okay? Let's say you're going to start a clothing store. Well, in order to start that clothing store, you're going to have to buy inventory. You're going to have to either rent or buy a storefront or design a website. You're going to have electricity bill, credit card fees, all those different types of things. There's a cost to doing business. And when it comes to the business of trading, your stop losses and other risk management is a cost in doing business. Your subscription for any trading software that you have, your subscription here on TradingView, all those things are just simply the cost in doing business. All right. And what we're trying to do, as you would with a business, you're trying to find something, an idea that's going to be profitable. All right, so you wouldn't go to Alaska and try to sell, tank tops and short shorts and bikinis and all that sort of thing. That wouldn't be appropriate. There wouldn't be much of a market there. You wouldn't go to Mexico and try to sell Arctic type survival clothing. There's just not a need for that. There's no chance of profitability in that business model. Likewise, you wouldn't set up a store out in the middle of nowhere where you might get one customer a year. You're going to go where there's people and you're going to try to sell a product that you think people want. Doesn't mean you're going to be successful at business, but what you're doing there is you're trying to set yourself up for success. And that's what we're doing here. We're taking the data, we're putting that data to the test, and we're giving ourselves the best possible chance to be successful over time. And so if you have any questions, be sure to watch all of our videos. If you haven't signed up for our free plan, you might want to consider doing that. There's nothing, we're not going to pressure you. We're not always going to try to sell you stuff. But what that does do is it allows you to get read-only access to our Discord. It's going to make us a little more likely to want to spend some time to help you out. Just you showing that interest by signing up for that free indicator. So definitely consider doing that and watch our videos. If you have any questions, be sure to ask them. We'll do the best that we can. Again, if you're a free member, you're not going to have the same priority as our paid members, but our goal here is to try to teach people how to trade, whether or not they choose to pay for a subscription or if they just want to take advantage of this free material. But if you could, consider signing up. That would mean a lot to us. Subscribe to our YouTube channel and not just do all that, but actually put the effort in. Try to be different from the others. Don't just sit there and hope for the moon. Learn to use these tools. Learn to back test, be willing to put in that work. And if you do that, you're going to set yourself up for having a good shot at success. So we'll see you in the next one. Thanks for watching.